In addition to the above tenets, members of this complex intelligentsia sought and embraced ancient teachings from Asia and disseminated the lessons of Buddha and other religious figures from India and Asia. For example, Madame Blavatsky traveled to India and remained there, gathering and studying ancient teachings for a number of years. Upon her return from the East, she brought a new wealth of ideas to Europe and America and shared much of what she had learned through the Theosophical Society.
All of these events beg these questions. Why did this intellectual enlightenment from the East to the Western world throughout the 18th and 19th centuries occur at that time in history? How does it affect the nature of and our perception of the complex system of economic cycles that periodically erupt into financial crises?
The answer to the first question is simple. The trade that brought this intellectual enlightenment was economic in nature. Therefore, it forms the basis for our continuing story. The pivotal event was the creation of the British East India Trading Company in 1600 CE.
The company reopened the Asia subcontinent to the west after 2 millennia of very limited contact. In 1608, ships from the company first arrived in India at the port of Surat. 2 centuries of communication and trade with the West already had been established before Blavatsky and other Westerners traveled there.
German polymath philosopher and teacher Rudolf Steiner brought much of the older esoteric knowledge forward into the 20th century. His writings continue to influence scholars to this day.
At the dawn of the century, Steiner involved himself with the Theosophical Society in Berlin. In 1904, he started to break away from the spiritualist faction because he claimed that they had gotten into objectionable practices.
For example, this faction was attempting to bring back the dead in order to use them to impersonate the relatives of clients at seances. Also, President Annie Besant began to present the child Jiddu Krishnamurti as the reincarnated Christ.
Steiner formed the anthroposophical movement around 1909. Important to our current discussion, Steiner dates and names the cultural epochs that begin with ancient India in the 8th millennium BCE.
These epochs include Persian, Egypto-Chaldean, Greco-Roman, and Anglo-German, among others. All of these epochs are of equal length, approximately 2,200 years.
Unfortunately, for our present purposes, reliable data on the economics that is currently available dates only to the Sumerian civilization of the Uruk period of the 4th millennium BCE, the middle of the Persian cultural epoch.
Historian Michael Hudson tells us that readable, detailed data in Sumerian economic records only began to appear around 2500 BCE. At this time, which was during the Bronze Age, certain professionals, skilled tradespersons, and managers began to pay a recorded fee to the temples or to the palace. As this system of tithing promulgated throughout the ancient world, the recording of credits of advance payments made and debits of accrued obligations owed needed to be made. As a result, written contracts, pledges of collateral, affidavits of witnesses, and sureties were recorded along with publicly regulated rates of interest.
Our takeaway from the observations made by Sidney Homer, Rudolf Steiner, Jeremy Bentham, and others is that the megacyclic economic changes move lockstep with the development and decay of empires across the ages of our human past. Overarching observations of previous economies read as follows. Sweeping economic change reflects the skills and knowledge of a population, its production of goods and services, the behavior of markets and trade, and a myriad of other factors.
These float atop an undercurrent of massive and lengthy cyclic changes in agriculture, planetary fluctuations, and our relationship to the Sun and companion planets of our solar system, against the backdrop of a universe in constant motion. Prices and quantities of product, labor and wages, and money and interest rates form simple markers by which we may gauge fluctuations over lengthy periods of time.
Though we may not yet possess the tools to measure the economic fluctuations of cultural epochs accurately, at least we have sufficient methods and data to measure the rise and fall of individual empires. In his History of Interest Rates, Sidney Homer offers evidence and explanation in the form of long-run interest rates over the lifespan of these empires. Dr. Homer measures interest rates ranging from the Sumerian Empire through more recent ones. He explains that, though interest rates remain in constant flux, they follow a long-run trend downward as an empire builds to its point of maturity, its golden age. Then, as an empire begins its process of slow decay into the abyss of history, interest rates begin to follow a long-run trend upward. The simple explanation for this phenomenon in economic terms is risk. The greater the uncertainty, the greater the perceived level of risk. In order to undertake increasing risk, the potential reward must grow correspondingly greater. Hence, the interest rate must be higher than it would be under conditions of greater certainty. The cycle of empires remains the longest fluctuation that we can measure in meaningful economic terms. The major financial crisis that we observe within the empire cycle is tied to the deterioration of the empire itself. The final phase of collapse often comes in the form of siege and sacking from without, after the empire already has been destroyed from within. Nevertheless, most of us are more interested in understanding fluctuations and the occurrence of crises within a smaller window of time. However, given an understanding of cultural epoch cycles and the shorter empire cycles within each of the former, we can begin to understand the nature of the temporal cycles that we experience within our own lifetimes. In our discussion of economic cycles, the debate continues as to whether or not shorter cycles are tied to or ride upon longer ones. The social science of economics exists in the space between natural and spiritual sciences. Traditionally, the current permutation of economics known as neoclassical leans heavily upon the concepts borrowed from physics and other natural sciences. The concept known as the Fourier harmonic series is one that we use to measure waves upon the ocean, currents of air, and harmonics in music and color. In economic cycle theory, we apply this concept to the apparent periodicity, recurrence at regular intervals, of different economic cycles.
We will treat the physics of harmonics as an analogy or metaphor when applied to series of economic fluctuations. The concept of economic cycles is based upon a theory that attempts to explain changes in business against long-run growth and decay trends as observed in market economies. In determining an economic cycle, we include such variables as growth of gross domestic products, aggregate household income, and labor employment rates, in addition to the factors mentioned earlier. Economists divide the cycles into two main phases, booms and recessions.